Have you ever heard of the term arm's length principle? It is an important principle that helps global companies like Google and Apple manage their taxes across different countries. In today's video, we are going to break down this crucial concept by explaining what the arm's length principle is, why it is important, key concepts like related parties and independent parties, method to determine the arm's length price, the importance of documentation in transfer pricing. Then we will highlight some real-life case studies involving major corporations. So stick around.
Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of TaxMobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos.
The arm's length principle ensures that transactions between related entities within a multinational enterprise are conducted as if they were between independent parties under similar conditions. It serves as a benchmark for determining transfer prices, ensuring they reflect market conditions. Two key importance of arm's length principle are: the principle prevents profit shifting, where profits are moved to low tax jurisdictions to reduce overall tax burden. It ensures fair and appropriate allocation of tax revenue among countries where the MNE operates, maintaining tax equity and avoiding base erosion. To understand arm's length principle better, let's explore some key concepts. Related entities. These are companies within the same multinational group, such as a parent company and its subsidiaries. Transactions between these entities are internal but must be priced as if they were with external parties. Independent parties. These are unrelated companies that engage in transactions in the open market. Their transactions are used as benchmarks to determine arm's length prices because they act independently and negotiate fair market terms. Arm's length price. This is the price that would be agreed upon by independent entities in a comparable transaction, reflecting fair market conditions and ensuring that neither party is advantaged or disadvantaged. Functional analysis. This involves understanding and documenting the roles, risks, and assets of each entity involved in intercompany transactions. It helps justify the allocation of profits based on the functions performed by each entity. Economic analysis. This involves comparing the terms of intercompany transactions to those between independent parties. This includes using comparable data to ensure that the prices set are within an acceptable range of arm's length prices. Now, let's explain some of the methods used to determine arm's length price and their application. Comparable uncontrolled price method. This method compares the price charged in a controlled transactions between related entities to the price charged in a comparable uncontrolled transactions between independent entities in similar circumstances. Application. This is used when there are identical or very similar transactions available for comparison, such as sales of the same product under similar conditions. Resale price method. This method is used when a product purchased from a related party is resold to an independent party. The resale price is reduced by an appropriate gross margin. Resale price minus margin equals arm's length price. Application. Suitable for distribution companies where the reseller adds value primarily through marketing and selling activities. Cost plus method. This method adds an appropriate gross profit markup to the supplier's cost in a controlled transaction, resulting in the arm's length price. Application. It is commonly used in manufacturing or services where a related party provides goods or services to another related party. Transactional net margin method. This method examines the net profit relative to an appropriate base, e.g., sales, costs, assets that a taxpayer realizes from a controlled transaction. Application. often used when traditional methods such as COP, resale price, cost plus are not applicable, focusing on net profitability rather than gross margins. Profit split method. This method divides combined profits or losses from intercompany transactions among related entities according to their respective contributions. Application used when transactions are highly integrated and contributions of related parties are significant and distinct, such as joint ventures. Importance of transfer pricing documentation. Transfer pricing documentation involve detailed records and studies that justify the application of the arm's length principle. This documentation is crucial for defending transfer pricing practices during tax audits and ensuring compliance with local and international tax regulation. To illustrate the application of the arm's length principle, let's look at some case studies. Case study 1, Google Ireland and Google France. Google Ireland Limited provided advertising and marketing services to Google France, and the French tax authorities claimed that the payments made by Google France to Google Ireland were not at arm's length, resulting in an underreporting of taxable income in France. Resolution. Google provided documentation to show that the transfer pricing adhered to the arm's length principle by comparing similar transactions between unrelated companies. However, to avoid protracted litigation, Google agreed to pay additional taxes. Case study 2, GlaxoSmith GSK in the United States. GSK US subsidiary purchased pharmaceutical from its UK parent company, and the IRS challenged the transfer prices, claiming that the US subsidiary overpaid for the pharmaceuticals, which reduced its taxable income in the US. Resolution. After lengthy litigation, GSK and the IRS reached a settlement where GSK agreed to pay $3.4 billion in taxes and interest, making it one of the largest transfer pricing settlements at the time. Case study 3, Apple Incorporated and Highland. The European Commission argued that Apple Incorporated profit allocation with its Irish subsidiary was not at arm's length, claiming it enabled Apple to shift profit to a low-tax jurisdiction and avoid paying higher taxes in countries where significant sales were generated. Resolution. The European Commission ordered Apple to pay €13 billion in back taxes to Ireland, arguing that the arrangement violated EU state aid rules. Apple and Ireland appealed the decision, and in 2020, the General Court of the European Union ruled in favor of Apple and Ireland, annulling the Commission's decision. In conclusion, the arm's length principle is crucial for ensuring fair taxation of multinational enterprises, maintaining tax equity, and preventing profit shifting across borders. Adhering to this principle demands rigorous documentation and thorough analysis to withstand scrutiny from tax authorities. By enforcing these standards, a balanced and transparent global tax system can be promoted. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.